Hello and welcome to the podcast hosted by myself, Louis Kessinger, and my dad, Tommy. We are a part of the Kessinger Lee Group at Baird and have been serving investors in our area for 4 generations. Our goal is to start a conversation around topics within the world of finance and to educate you, our listeners. All right, welcome back to another episode of Father-Son Finance. As a refresher, we use this segment to talk about topics that we think people should hear about, that are interesting, that are informative. It is a little less market heavy than ticker talk, and we're excited for the topic today because we are going to look into the magic 8 ball. Because now I'm
doesn't exist.
I'm gonna pose you the question of how do you know when the market is at a high or when the market's at a low?
Yeah, and it is amazing how many times in my career, I get this question of, hey, the market feels high to me, or feels toppy.
A little frothy.
Yeah, a little frothy, a little elevated. And, when it's at a low, people are like, is it ever going to quit falling?
Yeah.
And here's the thing, and maybe this segment's over after this sentence, but nobody knows.
Yeah.
Literally, today, we're sitting here April 15th of 2026, and the S&P just hit a new all-time high, and the NASDAQ just closed 3 points away from an all-time high.
Yeah.
And this may be it.
Yep.
We may not see this high again for I have literally been in places, right? In March of 2000, the Dow hit 10,000. Fast forward, it messed around and did some crazy things for a while. It didn't break through that number until 2012.
Yep.
12 years later. I didn't know that.
That's crazy.
Until the time. My point is, you can't tell a high or a low when you're in them.
Yeah.
The only thing you can do is see it on a chart before. And I always get a kick out of pundits who talk about things and say, well, of course we knew that the market was elevated in March of 2000, in February of 2020. We all knew COVID was going to do. Nobody knew.
Yeah, we all knew in 2022 inflation was high. They were going to raise rates, and we were going to see a pullback. We all knew that.
Yeah, of 35%, by the way.
Then why didn't everyone sell in January? But let me see here. I mean, So all that to say, no one knows, right?
No one. Now, no one knows the day it's a top.
Well,
or the day it's a
Except
bottom.
for you know from the hours of 4 p.m. that day to 9:30 the next day.
Okay,
because you just closed at an all-time high. But that's not really the question. That we're trying to answer, because we get the question, hey, how do you know? Does the market feel expensive to you?
Mm-hmm. Yeah. So tops and bottoms are only obvious after the fact. So let's just set that aside.
Mm-hmm.
So I can't ever tell you when the market high is or was going to be until after it happened.
Right.
And really more pronounced with the low. Mm-hmm. The lows feel gut-wrenching and they're brutally hard, and you're praying that they are over. But here's the thing. If you've been investing for a long time, or you've been with someone who has been, an advisor who's been investing for a long time, there are moments that do feel, you do feel a frothiness. You start getting questions from people that are completely off the reservation.
Uncharacteristic for them.
They're asking things about companies they would never invest in. Yeah. So let's take one at a time. At market highs.
Yeah.
You are typically I'm starting to then get questions about new IPOs.
Yeah.
People all of a sudden want to buy the newest IPO of whatever it is that's coming out.
Yeah.
Today's world is AI, biotech. I mean, I can go back through internet stocks and all kinds of things. But when you start hearing questions, the other one that I pick up on as an advisor is the markets may be up 18, 20%.
Yeah.
And maybe their 70-30 portfolio, so 70% in equities, 30% in fixed income and cash. Hey, how come we only did 12%?
Yeah.
Well, you took 70%,
Yeah. Of the market return.
Of the market return.
And they may still actually be relatively outperforming,
but
they're like, man, the market's on a heater. How come I'm not getting all of that?
Why didn't we put that other 30% in cash, cash into the market?
Yeah.
We all knew, this is my favorite, we all knew it was going up.
We all knew it was going up.
You did?
Yeah. Well, but why did they all know it was going up? Because you see other things like walking into a bar.
Yes, and CNBC's on.
Like watching after hours. People are like watching earnings reports. People who are not financial advisors.
So one of my favorite indicators of market tops or near market tops, and this is less so today, but it was early in my career, the 90s and early 2000s.
Yeah.
Every discount broker available advertises. They're flush with money, and they start, advertising about, trade stocks here. We've got this program that'll help you buy and sell. Those commercials are everywhere. When the market's bottomed, all those commercials are gone. And usually when markets bottom, interest rates also have bottomed. So interest rates have gone. So what commercials do we see when interest rates are very low? Have you refied your house?
Yeah.
Have you gotten a new interest rate? Did you get a home equity line of credit and go see the world?
You should get a personal loan.
You should get a personal loan and do the things you wanted to do because you lost all your money in the market. And don't you want to do something fun?
This is the best credit card in the market.
Yes. Yeah. So in a way, you can sort of, start to take some profits as you see more and more advertisements for discount brokers or people who are selling. I picked the last 10 winners of all these things. And if you buy my process, you'll get the next 10 winners too.
Yeah.
That you should probably go, it's a little frothy. And then opposite, when you start to see all the mortgage companies coming out saying, hey, have you refied your home? You may be thinking, you know what, maybe I should refi my home. I won't say the next sentence because compliance will be like, you can't say that. But that's when maybe you should start thinking of making your IRA deposits, depositing some money, legging your way back into a market that has pulled back.
Yeah. And some of these things are so counterintuitive because when the market is reaching all-time highs every day, new all-time highs every day, and your cousin's buddy invested in some company that went parabolic and he quit his job because he made all this money. And
that's real.
God, if you would have just done that. So now you get the FOMO of, hey, I am 70-30. Why don't we just invest some of this cash? Then when you do get to the mortgage companies advertising and you're approaching the lows and you put all your cash into the market all the way up, you don't have any left.
Right.
And so, again, just know your allocation and know what your plan says, because if you don't have anything to take advantage at the low, then you can't.
Yeah. So lows are the polar opposite. So lows, highs feel great. your statement goes up. It goes up every month. It feels amazing.
Yeah.
Markets turn
You
and
get nervous because it might go down, but you're making money the whole time, so it doesn't really matter.
Right. When markets go the other way, when they are, and the way markets make bottoms is over time. So there's usually a quick downdraft, then a pause, and then maybe earnings, start getting lowered by the analysts. Companies make a little less. Maybe oil prices are higher. Maybe interest rates are higher. Their cost of borrowing causes.
All of a sudden, people are getting fired.
God forbid you have an economic situation where people are losing their job. And as people lose their job, they stop spending because they don't know where their next job's going to come from. And so, bottoms just, they feel endless. They can happen. They can take years to develop.
It's like water torture, I've heard you say before, right?
It is like water
Just
torture.
Drip, drip.
March of 2000, it was not until October of 2002 that the market bottomed in that particular cycle. And it took another 2-3 years for that to recover. We had another high in 2007. And then October of 2007, the market peaks, and it's March of 2009 before it fully bottoms. And so bottoming takes a long time.
Before it fully bottoms, by the way.
All the fun out of it.
Not before it, gets back to a new all-time high.
Right. Yeah, we're talking about lows.
That is 2 years until it gets to the bottom.
Right. Which is why I think people try to time the market, which is almost impossible because they loss avoidance is real. As humans, we would rather avoid a loss than even make a gain.
Right.
And so I think that's what happens is I think that's the natural. My statements moved up. I don't like the thought of losing what has been gained here. Is this the top?
Yeah.
Are we at a top? So that you don't have to feel the pain of the bottom. And if that's you, that's okay. You just need a rebalancing strategy.
Yeah.
You just need something that will sort of cultivate those gains, put a little bit more in that fixed income, and have a process to do that. Other people, professionals, just know that, like, all right, this too shall pass.
Yeah.
This is awful. Your biggest issue as markets are bottoming is just to make sure that you avoid companies that go bankrupt.
Yeah.
And I know that sounds simple. Like, of course, Tommy, of course.
Yeah.
Well,
or if I knew how to do that, then, I wouldn't be sitting here. But you can invest in indexes.
You can invest in indexes. You can step to the sideline. There's an old adage on Wall Street that says when markets are falling, get small. What they mean is take those losses, the original losses. You're down 10, 15, 20%. Take those losses, shrink your portfolio size, battening down the hatches.
Yeah.
So you're shrinking your portfolio size. So you're going to weather the storm. I've got the companies that I know are going to make it through, hell and high water. And then I can get big on the other side.
Yeah.
And this is something I wanted to point out. Coming off of lows, you do not need to hit the low.
No.
So the NASDAQ bottomed in March of 2009, and it was down 60% from its high. If you were smart enough and you could actually click the button on March 9th of 2009 and make the purchase, you're up like 1,700% or some crazy number.
Something nuts.
I will just tell you, I was in the fetal position under my desk. I didn't press the button on that day. But I have multiple instances where we did press the buy button at the end of March after it had bounced off the low and was up 10, 15% from the low. So your brain goes, you're too late. You need to wait. It's going to back off. Well, all right, we did miss it, but we're up 1,400%
Yeah.
now.
I'll take that.
17 years later.
I'll take that.
Yeah. Okay. So my point is, it's okay.
Yeah.
You don't need to try to catch the falling knife.
Mm-hmm.
You can let the knife sink into the cutting board.
Yeah.
And then wait for that recovery to be sure, like, okay, it is going back up.
And the other beauty that a lot of people across the country have is your main way to invest is in either an individual retirement account
Yeah.
or a company
401k.
retirement plan.
Mm-hmm.
And so, man, those are such great tools if you can take advantage of them, because, we say, hey, the highs are great unless you're a total doomer who thinks we're going to go to zero. But otherwise, you're making money the whole time, and you maybe are just nervous that, well, maybe we'll get a pullback, and I don't know how to time it. But the lows are just months on months on months of bad news,
Yeah.
of your life savings
Right.
and retirement balance getting cut by 10%. That's a bummer. Getting cut by 25%, that's a quarter.
Right.
Getting, you're down 50%. Hey, half your retirement's gone. That's a psychological bomb.
It's a psychological bomb. And so, what we want to leave you with here is not like this depressing, like what happens at the lows and what it looks at, but stick to a plan.
Right.
So the action items that you should do in these extremes, whatever those are. So our most recent extreme really was 2021.
Mm-hmm.
There was a really frothy top coming out of COVID. And if you have a plan,
Mm-hmm.
stick to the plan. Keep a strong perspective.
Mm-hmm.
What is your time frame?
Yeah.
Is it next month? You need to adjust.
Yeah.
Is it 10 years, 20 years? You don't need to adjust.
Mm-hmm.
It's going to be okay. But I do like this. You'd written down here to adjust the risk thoughtfully, not emotionally.
Mm.
So adjust your risk within the context of your plan. So we mentioned you were 60-40, market goes up 3 years in a row, you're at 80-20. Thoughtfully, not emotionally, adjust that balance.
Yeah.
You were at 70-30, market's down, you're now 50-50. This one's way harder.
Yeah.
Way harder than the other one.
You got to take your safe stuff.
I got to take my safe stuff, and I got to buy the thing that
just went down 25%.
That has bit me really hard. But if I have a plan and I'm thoughtful, not emotional, then I need to adjust that 50-50 back up to the 70-30. I got to sell that thing that's a rock and move it into things that are really, really undervalued. And if you do that, those two things over time, the highs and lows will actually begin to get more comfortable for you.
Yeah.
And you'll begin to see them for what they are, which is opportunity.
And you'll start to see and be able to look out for some of those things we talked about, like CNBC at Buffalo Wild Wings.
Yeah.
Like your barber or hairdresser who bought a stock and they're thinking about, quitting cutting your hair until next month when it goes down, or, mortgage companies advertising at the low when everything feels like it's never going to be good again and you haven't seen the sun in months. But you'll start to recognize those patterns and what happens near the highs and near the lows, because nobody ever knows what day the high or the low is going to be.
Yeah. Impossible to predict the market. Very possible to control your behavior through those.
Yeah, absolutely. Well, hey, thanks for listening. We hope you took something away. And if you think the market is at a top, think again.
This podcast is intended for informational and educational purposes only. It is not an offer to buy or sell or solicitation of an offer to buy or sell any security or investment or to participate in any particular trading or investment strategy. The information is considered to be from reliable sources, but its accuracy is not guaranteed. We do not offer legal or tax advice, so please consult your tax or legal professional for information specific to your situation. The opinions expressed are those of the speaker and not necessarily those of Robert W. Baird and Company Incorporated. Please note past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. You should carefully consider investment objectives and risks of any investment before investing. An investment cannot be made directly in an index. Securities and investment advisory services are offered by Robert W. Baird and Company Incorporated, a registered broker-dealer and investment advisor, member NYSE, FINRA, and SIPC. You should consider the investment objectives, risks, charges, and expenses of each money market fund carefully before investing. This and other information is found in the applicable prospectus for the money market fund. Contact your Baird financial advisor for a prospectus. Please read the prospectus carefully before investing. Money market funds are managed to maintain a stable $1 share price. An investment in a money market fund is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Although the fund seeks to preserve the value of your investment at $1 per share, it is possible to lose money by investing in the fund.